Hello, everyone. Thank you for joining us today. My name is Demet Çanakçı. I'm a program director at Toronto Center. Welcome to our Financial Inclusion and Gender Equality Community of Practice webinar series. We are delighted to host three guests today, John Frost, Sharon Chen, and Sebastian Dorr. You have received their bios, so I will briefly introduce them. Sharon Chen is a founding member of Ernst & Young FinTech team and the lead author of the Global FinTech Adaptation Index 2019. She drives global and regional FinTech strategy and collaborates across the financial services ecosystem on FinTech trends and policy development. She will join us in a couple of minutes. John Frost is a senior economist in the Innovation and Digital Economy Unit of the BIS. In this role, he conducts policy-oriented research on fintech and digital innovation. Previously, John worked at the Financial Stability Board and the Dutch Central Bank, among others. Welcome, John.
Thank you.
Sebastian Dorr has been working as an economist in the Innovation and Digital Economy Unit of the BIS as well. His research interests cover financial intermediation and macroeconomics, with a focus on how innovation affects the financial sector and the economy. He was awarded the European Economic Association's Young Economist Award, as well as the Young Innovators Award at the World Bank Forum. Congratulations again, Sebastian, and welcome. In today's session, we will be hearing about the recent publication titled The FinTech Gender Gap. It is an interesting paper. I encourage you to read it, if not already. Before I pass this over to Sebastian, I want to thank our funders, Global Affairs Canada, the Swedish SIDA, International Monetary Fund, Jersey Overseas Aid and Comic Relief, and USAID, without whom we couldn't achieve our global mission. Please use the Q&A tab to submit your questions. We will try to answer as many questions as we can. It is now my pleasure to hand over the session to Sebastian for his presentation. Enjoy the session, and over to you, Sebastian.
Thank you for the kind introduction and giving us the chance to present our work here. So the FinTech Gender Gap is joint work with Sharon from EY, John, Leonardo, and Yun Sung Shin at the BIS. John and Sharon are on the call and will join me later also for the Q&A. So we all hope that FinTech is fostering financial inclusion, right? So the idea is it's transforming financial services, and many policy initiatives have the explicit goal to foster financial innovation and improve access to finance for the underbanked. And so one big question is whether the FinTech gap, whether FinTech can close the gender gap in access to financial services. So we know from the World Bank data that around 72% of men globally have a bank account, but only 65% of women do. And so FinTech promises, by using non-traditional data, machine learning, and other new technologies, to maybe overcome this challenge and hopefully narrow that gender gap. So what we want to know in this research paper is whether the use of FinTech products and services differs between men and women. And so we will importantly distinguish between FinTech products offered by FinTech entrants and traditional financial institutions. And once we address this point, the next question we're asking is whether we can explain any observed differences in the use of FinTech products, whether they center around privacy, economic benefits, or other attitudes toward technology. And to answer this question, the main data we're using is the EY Global FinTech Adoption Index from 2019. I'll give more detail in a bit, but basically it's a survey of around 27,000 adults in 28 countries, that is within each country representative by gender and age. And the survey asks detailed questions on the use and attitudes towards FinTech. So the key finding in our paper is that men are more likely to use FinTech products or services than women. And this is what you see in the graph here. So on average, 29% of male respondents say that they use fintech products or services by fintech entrants, and 21% of women say that they do. So that's an 8.4 gap in the average. And as you can see, the pattern is present in almost every individual country. So the red dots on the right side in the graph are the share of male respondents that use fintech in each country, and the black dots, the female respondents. And except for Peru and India, where the gap is very close, everywhere men report using fintech more. There's two outliers here, China and India. That's mostly explained by payments apps that are being used. Now, arguably, fintech products, cover different aspects from peer-to-peer loans to managing your money and so forth. But actually, when we look at different categories of fintech products, the gap is also there. So when we try to understand what could explain this gap, the first thing we look at are individual characteristics such as age, income, education, but also country characteristics. So whether you live in a richer or poorer country, your financial development, and so forth. And when we account for these factors, we do find that the gender gap narrows, so from 8.4 to 5.2 percentage points. So that's around a 30% decline in the gap, but the gap is still there. And actually, when we plot for each country the average gap, that's what you see in the right in the graph, once unconditionally, so just the raw gap that's there in the data, and then once conditionally by taking into account differences in individuals' age, income, and so forth, we actually find that there's a very high correlation. So that suggests that individual characteristics, at least the ones we can control for, but also country level differences don't explain that much of the gap. So another question we're then basically asking is whether it matters who offers the fintech product, right? So it could be that maybe if the fintech product is offered by a traditional bank, maybe then there's no gap there as to oppose it's been offered by fintech entrants. And so when we do that, we find a few interesting patterns. So actually, more respondents say that they use fintech products offered by traditional banks than if they're offered by fintech entrants. So that's the average, almost 50% versus 25%. And interestingly, respondents are more likely to use fintech entrants if they also use fintech products by traditional banks. So this could suggest that actually fintech is more of a complement rather than a substitute to traditional banking services. That being said, we do find that the gender gap is almost identical across both groups. So it doesn't really matter whether the product is offered by a traditional financial institution or by a fintech entrant. The gap is similar in magnitude and not statistically different. So this could suggest it's rather more about the product, so the fintech product, rather than the provider that could be responsible for the gender gap we observe. Now, so I've told you all the things that don't explain the gap. So of course, it's more interesting to provide some answers of what could explain the gap. So what we do is we document in the first step differences in gender attitudes towards privacy and technology. And so specifically, we want to know whether individuals are more or less concerned about privacy when they're dealing with companies online, their general willingness to use new financial technology, also their price sensitivity. So would you be willing to use or to switch to a fintech entrant if they would offer cheaper services or better rates? And finally, a product fit. So the idea being that maybe fintechs offer products which simply are better tailored or more innovative and suit my lifestyle better. So we first document differences in these attitudes, and then we want to know whether the differences in these attitudes could explain the gender gap. So the first thing in terms of documenting differences, we find that women report that they are more worried about their security when dealing with companies online, and they're significantly less willing to adopt new financial technology, for example, digital banks. Again, these questions come from the survey. Men instead are more price sensitive, so they are more willing to use a fintech entrant or even share their personal data with fintechs if cheaper offers would be the result. While women are actually less willing to use a fintech, even if the products are somewhat better suited to their needs or lifestyle. So the next thing we do is there are differences, obviously, in attitudes towards fintech products. But the question is, can they narrow the gap when we account for them? So what we do is we subsequently account for these differences across genders. And we find that actually worrying about your security or the difference in the suitability of products don't really narrow the gap. Instead, what explains a large part of the gap is that there are differences in attitudes to technology and price sensitivity. So they bring the gap down from 5.2 to 2.3 percentage points. So in a nutshell, if we control for individual characteristics in the sense of age and income, as well as country characteristics, and then on top of that, for attitudes and price sensitivity, the gap declines by 75%. So that's a huge drop. That being said, 2.3 percentage points is still around 10% of the average adoption rate, which is 25%, but that's still quite a significant gap. But I think it's good that we find some variables that could explain the gap we're observing. Now, of course, now we know that there's difference in attitudes, but what determines these differences would obviously be the next question. And so in our paper, we cannot answer this because this is not explicitly part of the survey. But we think there's three major explanations based on previous literature that could explain differences in attitudes and hence also a large part of the gender gap. So on the one hand, there could be differences in preferences across genders. There's been a lot of work showing that, for example, women tend to be more risk averse than men. So it could be that simply by being a new technology, it will take some time to be adopted. Another explanation could, of course, be gender-based discrimination. So there's also, I think, convincing evidence out there that loan officers have certain biases. There might have been discrimination in the past, and that might discourage some people from actually, using new technology. And the final explanation we think is a possible one is that there are social norms and laws that might affect the cost-benefit trade-off. So what that means is that maybe the leak of data could be more severe for women than for men, for example. Then even if a product would give the same benefit to both genders, if the costs of, say, a data breach are disproportionate, then that could discourage women from adopting fintech, which usually relies on data-intensive technology. So in terms of policy, we argue that there will be more research needed to pinpoint the underlying cause of the gender gap. So as we mentioned, attitudes differ and they go a large way or a long way of explaining the gender gap. But what determines those attitudes or price sensitivities is at this point an open question. But we think that, depending on the cause, it could be the case that if you want to foster financial inclusion through technology, you might need policy support that takes into account explicitly that the willingness to share data or to use technology differs across subgroups in the population. And again, only if we know the cause, we can actually design the right response in terms of policy. So in that sense, we think it would be promising to look further and better understand what determines differences in the attitudes to technology and price sensitivity to understand how to design best policy. Now, this is basically the key message of the paper. And now I'll spend the next 10 to 15 minutes to give you a bit more background to convince you that what we find is more than just a few pictures and correlations, but there's a solid analysis behind that, so that we're really convinced what we find is a very consistent and strong pattern that is hard to explain. So let me spend a few minutes on the Global FinTech Adoption Index first, and then move into the analysis. So the FinTech Adoption Index by EY is based on a survey of 27,000 individuals in 28 countries, so roughly 1,000 people per country. It's representative in terms of gender and age within each country, but it's an online survey. So one drawback here is that we only interview people, or EY only interviewed people that actually have access to the internet. Now, in terms of fintech usage, it might not be the worst thing because without internet, you can't really use most of the fintech services, but that's important to keep in mind. And the survey asks detailed questions on the use and attitudes towards fintechs, but also towards traditional financial institutions or non-financial services companies. We also know respondents' age, gender, income group, education, marital status, employment, country, and language. And just as I mentioned in the very raw data, the fintech gap is already large. So 29% of men use fintech products offered by fintech entrants. 21% of women do, and it's present in all subcategories. So it's true in payment products, investment, borrowing, financial planning, or insurance products. And there's also quite a few other differences in attitudes. So this basically just shows you the same in the picture. So once more, in every individual country except for Peru and India, there's a significant fintech gender gap. The left figure shows you basically the difference within individual product categories. And as you can see, some fintech products are used more than others. So payments, for example, is by far the most used fintech product in the survey. But the gap is there in every individual category. And actually scaled by mean adoption rates, it's quite similar across different products. Now, when we investigate those patterns in more detail in regression analysis, we basically want to know whether, the outcome here is just a dummy saying it's a value of 1 if you use a fintech product and 0 otherwise. And we regressed that on a female dummy. So basically, the beta here would tell you if it's positive, women would use fintech more than men. If it's negative, they would use fintech less. And the nice thing here is that we can control for a host of factors, including individual characteristics, but also everything at the country level. So we can basically abstract from factors like financial development, average internet access, GDP per capita, and all these things at the country level that could explain or potentially explain the gap. And so when we do that, so the right-hand side is the regression table, but I think we can ignore most of the details here. So when we add more and more of the controls that could explain the gap potentially, so characteristics at the individual level, at the country level, and so forth, the gap narrows, but it never disappears. And it also doesn't disappear when we only focus on those that already use banks or don't use banks for fintech products and services. The gap is actually quite similar in both groups. And again, in the final column 6 and 7, what we do is we really compare 19 individual fintech product categories. So we very narrowly separate fintech products in different groups, but we find that the gap is present even if you compare very similar products. I mean, in principle, you could think that maybe for some reason, men only use payment fintechs and women only investment fintech products. And that could maybe explain the gap, but actually we show that that's not the case. The gap is there in very narrowly defined product categories, which we found quite striking. Similarly, when we compare fintech entrants and traditional FIs, again, controlling for all these factors that could confound our findings, if anything, the likelihood to use a fintech entrant is higher if you also use a traditional bank that offers fintech products and services. So again, we think this could be a sign that fintech is a complement to traditional banking services. That being said, when we control for all different factors, the gender gap is identical, statistically speaking, between whether it's offered by traditional banks or fintech entrants. That would be columns 5 and 6, the interaction coefficient for those of you interested in regression tables. So one interpretation of these results could be that the gap is not specific to who is offering the product, but rather that the products themselves matter. Okay, so we can't explain the gap, or we couldn't make the gap go away by forcing all fintechs to be bought up by banks. Not that we would want to do this, but it also wouldn't make sense to close the gap. So what could explain the gap? I already gave you a brief overview, but basically in the survey, we have quite a few questions on different attitudes. So one is about the worry about security. The question reads, I worry about the security of my personal data when dealing with companies online. So we basically assign a dummy if a respondent says yes to that question. And then we do a first principle component analysis. So basically what we do is we take a bunch of questions which ask about similar things. So your willingness to adopt financial technology, to adapt products for cheaper offers, or because products or services would better fit your lifestyle. And then we just combine all these different questions into one common component. And then we want to know whether this component differs across genders. And indeed, we find that there's a significant difference across men and women. Again, female respondents tend to worry more about their security on average, but are less willing to adopt new financial technology. Women are also less price sensitive, so men are more willing to use a fintech entrant, but men are more willing to switch to a fintech if they offer better products and products better tailored to the respondent's lifestyle. Okay, and all these differences are quite strong and pronounced across genders. So the next thing we do is basically account for these factors directly in our regressions to understand how much of the gap they can explain. And so in that table, if you want, you can focus on columns 5 to 8. So basically the coefficient on the dummy female indicates the size of the gap. So in column 5 would be minus 5.3 percentage points. And then we account for the variable about security. In column 6, we add technology, so attitudes and technology as a control. In column 7, we add price sensitivity. In column 8, we add the product fit. And what you see is that, so from column 5 to 6, and then again from 6 to 7, the coefficient declines on the female dummy by quite a bit, from 5.3 percentage points to 2.3 percentage points. Further adding the product fit doesn't really do much. So what this means is that attitudes towards technology and price sensitivity really could be factors explaining why this gap is there. But as I mentioned a few minutes ago, our survey doesn't allow us yet to determine what could explain differences in these attitudes. And I mentioned discrimination, could be preference, could be social norms, and we need more research to understand what is driving these differences in attitudes to inform policy. We perform a few further exercises in the paper. Let me skip that, I think, because I'm probably in the Q&A, some of these will come up. But so one thing I want to mention here towards the very end is that not only the dimension across genders matters, but also the trust in counterparty. So basically, who's providing the service. So in the survey, we did find that fintech entrants and traditional financial institutions offering fintech products exhibit a similar gap. But nonetheless, when we ask about the willingness to share data in exchange for better offers, there is a pecking order. So basically, in the survey, there are questions whether you would be willing to share your data for a better offer with either a traditional bank, a fintech, or a non-financial services company. So, for example, a big tech. And pretty consistently in most countries across the world, consumers are most willing to share their data with traditional banks, then with fintechs, and only then with big techs. So think of Amazon, Google, Tencent, and the like. Although, to be fair, definitions vary a bit across countries. So we think this is an interesting pattern to the extent that apparently, at least in terms of who you trust more or less, your counterparty matters. And here at the BIS, we have another work in the making, which should come out tomorrow around noon, where we use very good data, high quality survey data for the US on US consumers. And we asked them basically, how much do you trust each counterparty to safely handle your data? And there's a very similar pattern. So they trust banks the most, traditional FIs, and they trust fintechs, but also government agencies to a similar extent, but less than banks. And they have far the least trust in big techs. So this pattern is really consistent. And interestingly, the survey was in September 2019. So we asked consumers about how COVID-19 has affected their willingness to share data. And there was, again, a very strong pattern that is varying to the extent that COVID-19 has exacerbated previous previous pecking orders, basically. So a quarter of respondents became less willing to share their data in general in response to COVID-19. But almost half of these were less willing to share their data with big techs. Okay, so the ones they trust the least to begin with, they became even less willing to share their data with. Traditional banks, on the other hand, so on the right-hand side would be the blue dots, see the lowest increase in distrust during COVID-19. And I mean, this obviously matters, right? We all have to rely on, I don't know, be it Zoom, be it remote work, be it online shopping. So we all rely more on data, but people became more concerned. They don't trust everybody equally. So in terms of like policy, I think it has quite interesting implications. But let me wrap up and then open the floor for questions. So data lie at the heart of the digital economy, and the quality and representative of the data are crucial. It could be that an uneven provision of data could lead to biased algorithms, discriminatory pricing, and so forth. And so just having better technology might alone not really help us close the gender gap in the access to financial services. Instead, we might need policy to support this financial innovation. And that policy needs to take into account that different groups of the population have different concerns. and are less or more willing to share their data, for example, or less or more willing to adopt new technology. And so this new normal we're living in of remote work, Zoom presentations, might not benefit all groups equally, because although we all have to do it, some might like that more and some might like this less, or become more or less concerned about what would happen if the data would be leaked, for example. And so just to wrap up, the FinTech Gender Gap, you can read up the paper on the BIS webpage, but we find a very strong pattern. In almost all countries in the survey, women use FinTech products and services less than men. And it's very hard to explain the gap just with individual characteristics or country characteristics. Instead, it seems that attitudes to technology and price sensitivity go a long way of explaining the gap. But we definitely need more research to understand what determines differences in those attitudes. So let me stop here, and I guess at this point, John and Sharon will join me for Q&A. Demet, back to you.
Thank you, Sebastian. It's a great presentation, very informative and to the point. This is the advantage of having 3 speakers. Some questions are already answered live.
Okay.
Yeah, perhaps we can just, still go over those questions to see if you would like to add anything. So one of the questions were, if I own a fintech service and my wife uses it, to which gender would you assign the use of the service? Might this be creating a false perception of a gender gap?
So I assume John or Sharon answered that at some point we split the sample into those that live alone and those that don't. So I mean, it's true. In a household, we wouldn't know who's using the service. But if you focus on the respondents who are alone, in that sense, we find a similar gap.
Okay, thank you very much. So Calvin is, okay, that's answered. So there's one question here.
Sorry, if I could just cut in on that last question. Yeah. I do want to, apologies, I do want to point out that, I guess we're starting video. There we go. I do want to point out that FinTech, as most of the FinTech solutions are very mobile phone based. So in theory, you can share an account, and there are some, I guess, products that are designed to be shared between families or couples, but actually it's, as propositions, they're very individualistic. So it's possible that we're not seeing, what we're not seeing is if, in a traditional split of duties, women might be looking after childcare and men might be making financial decisions. So we might not see whether or not there's an indirect benefit of a woman whose husband is using a FinTech product and saving on behalf of the household. But if we're looking at who's using the product in and of itself, then I think it's what we've got here is a pretty fair measure.
Mm-hmm. Thank you. Yeah, thank you very much. So there's one question not answered yet. I think it's just a matter of preference. Now, wouldn't it be more important if the gender equality was based on who makes more fintech products? Anyone wants to answer?
I'm not sure I fully understand the question. Yeah. I'm sorry.
Well, to kind of maybe take a stab at the question, I think it's very separate to this piece. There's quite a lot of thinking and questions around how do we get more female founders into not just the fintech space, but into the tech space, and whether or not there's institutional barriers, financing barriers, cultural barriers, whatever they are. There's a lot of people researching this, speculating, trying to fix that. I think it's important to ask the question of whether or not fintech is reaching women, because very much because the idea and the reason fintech has had so much traction is that it promises to be better in however you want to define it, whether it's cost or whether it's better user experience, but better than what products might be available. And in that case, if you're looking at it from a societal benefit perspective, you want to make sure that those benefits are able to trickle down to all parts of society. In this case, we're looking at gender, but if you look at the industry, there's also concerns about making sure it hits the more the elderly or the less technologically less technologically skilled, or making sure it hits more vulnerable populations without certain IDs and so on. So I think it's important to remember it is a industry, but also given the impact it's had on the industry itself and on financial services, making sure that the benefits trickle down and reach everyone across society.
Thank you very much. Okay, George is asking a question here. Interesting report, an important contribution to an emerging focus on diversity and financial services. Did your analysis discover any similar results in Insurtech? John?
So
yeah, please go ahead, Sharon. I'll come in after you.
I was going to say that our definition of fintech in this case covers Insurtech, wealth tech, pay tech, kind of quite broad brush. There's, I think, 19 services we've included in there, and they cover, they touch upon what we think were the most popular and most available globally across all the consumer financial services products. So yes, it does cover Insurtech. I don't think we've done the analysis to see if there's a difference between Insurtech versus wealth tech versus, say, digital banking services.
So we have found that there is a gender gap across each of the 19 services, so that includes Insurtech. And I think that it's notable that a lot of the discussion on financial inclusion and the use of technology for financial inclusion, references the potential of Insurtech solutions to help, small businesses, to help, women, for instance, with crop protection. There are a lot of these examples that we hear about that are very promising indeed. But at aggregate level, I think it is notable that we see a gender gap for the Insurtech space as well. So it seems that at aggregate level, Insurtech is not yet helping to close the gender gap.
Although, to be fair, we don't know if it's bigger or smaller compared to other categories. So we didn't check that explicitly. So it could be that Insurtech is still doing better relatively, but we didn't check that yet. But the gap is there. So in that sense, correct.
Okay, thank you. While we are getting other questions, I have a question. Your survey sample consists of more advanced economies. Do you think there will be differences in your results if you work on some emerging market economies?
Well, there's a number of emerging markets in there, and I will agree that they're not necessarily representative of all the, I guess, the different levels of development. But aside from the developed markets like the US and the UK and a lot of Western Europe, we did try to bring in markets like South Africa into the mix, and in this 2019 we included quite a lot of Latin America as a bit of I guess to try and represent some of what the interesting activity happening in that space.
Okay, thank you. I'll continue with the questions from participants. Quite an insightful paper. My question is, how do you take into consideration variations in digital divide, robustness of ICT infrastructure, discrimination against women across the countries involved in the study? Also, do you think the level of financial literacy has any effect on gender gap on the fintech industry?
So I can take this, and I think Sebastian will also have some things to add. I should note that our survey is of digitally active respondents. So it assumes that the respondent has access to digital technologies, which means that it likely understates the gender gap. Indeed, there are indicators showing that women, there is a digital divide. Women are less likely to have access to digital technologies to start with. And we show that even among those who have access to digital technologies who are able to, take part in the survey, there is this gap in the use of fintech. We also have a proxy for financial literacy. It's not a perfect proxy, but we do have a question, and we find that the results are robust to including this measure of financial literacy. Sebastian, I'm sure you have something more to add here.
Yeah, so one thing to point out is that we do know the country you're in, but we don't know which part of the country. So arguably, if you look at larger countries, there could still be huge differences within countries in terms of, gender attitudes, discrimination, things like that, that we can't pick up in this survey. So all we can take care of is the average in each country. That said, so the US survey I briefly mentioned at the end, there we ask a few questions which are more detailed on literacy, who takes financial decisions and so forth. At least in the US, they don't explain the gap. We do find, however, that in areas where people perceive there's more discrimination against women, they're less willing to share their data. So it could be, it's still in the making, so I don't want to make too bold statements here. But so that would be in line with, I think, what you have in mind with your question. But the survey we have in this paper, we don't know the disaggregated data at the country level. Sharon, I don't know if you have further thoughts.
Yeah, I'm afraid we weren't able to, we had to limit how many questions we put in there.
Okay, thank you. Next question. I have heard that self-service gas stations came into being because soccer moms prefer not to leave their cars when buying gas. Unexpected question. Is there a similar example in FinTech?
So the question is whether the demand for a product leads to that product being made or offered. I guess that's the...
Yeah, I think that's my understanding. Otherwise, John can rewrite, but yeah.
I don't know, Sharon, John, any examples?
What I would say is that if you look at most tech startups, including in the FinTech category, and you speak to the founders, there's always an origin story about why they think there's how they got inspired by the idea and why they think it's something that needs to be resolved with, new technology or a different approach. And that's everything from, some of, for example, if you speak to a founder of a remittances company, then they might be an immigrant themselves, or they might have had experience working with people of immigrants, and therefore that's been the inspiration for going off and starting what they do. So nothing immediately comes to mind quite as specific as the example that's given, but there is, I think, within the industry, a general acceptance that not only do you kind of have that origin story or try and fill niches in the market, but also as part of the design of the product, you incorporate quite a lot of customer feedback in tweaking what you initially might have started off into what actually gets presented, or what by the time you get to your Series B or C, what is the product that you're trying to really scale up.
Yeah, John, clarify the question. Whether there are any FinTech products preferred by women. That's what he was trying to ask.
Okay, I'd say that's quite broad brush, because I think that's when you start talking about when I venture into the category of intersectionality, because what women might want at age 50 might be very different from what someone in their early 20s might want, and also brings into very specifically into their needs and to their goals. One thing we are seeing is that products that are specifically targeted at women do try to overcome some of that literacy points, tends to be a bit more social, builds communities and networks. Those are all approaches that a lot of FinTech startups have adopted to try and reach more women as their customer base.
Okay. So that must be a good answer, because he thanked already. Thank you for the question, John. And so we have 2 questions from Carol, I think. First, do you have any plans to conduct more research to look at those without access to technology? Are you pursuing further research in this area?
I don't know, John, if you want to make a CBDC example on offline CBDC, but please go ahead if you have any ideas.
Sure. So one of the issues with doing research on financial inclusion, and particularly for people who are not digitally active, of course, it becomes much more difficult to collect data. There is a lot of research, and I'm sure people in this community are very familiar with, the JPAL and the work by Duflo and others that really looks at RCTs in emerging market developing economies, sends surveys, sends people to collect data. A lot of what we do is based on digital digital data sources, which where it's by definition a bit more difficult to reach people without access to technology. So this study, I mentioned that by construction we only have information on digitally active respondents. Of course, we're not able here to get information on people who don't have access to digital technologies. But the point that Sebastian was mentioning is that there is a lot of research on how digital technologies can be made more inclusive. And I think that one interesting example is in the central bank digital currency research. There's a lot of discussion about how central bank digital currencies can be constructed to be inclusive. Can be used for offline payments. So even for individuals who don't have access to a smartphone or even a feature phone. So there are, in China, for instance, the People's Bank of China is looking at interfaces, including prepaid cards and other means for offline payments. And I think there are a lot of Bank of Canada staff have written about universal access devices. So these are very low cost devices that would be just for payments in central bank digital currencies. And these are specifically meant to allow for digital payments by people who don't have access to a smartphone or feature phone, or who might not be comfortable using it for payments. And I think that that's a really important area, particularly in light of the groups that are most vulnerable and least likely to have access to digital payments currently. Think about the homeless, think about migrants, visually impaired people, so different more vulnerable populations. So yeah, I think this is a very important area of research. We don't have good data sets on these populations, but certainly we're following what's being discussed here and the technological solutions that are meant to cater to these specific segments.
Okay, thank you. I do have another question. So based on the, I read the paper, it's really interesting. And if the differences in adaptation rates for fintech products are based on the differences in hardware preferences, behavioral thing mainly, then the scope for interventions through policy would be limited, I understand. Are there any role for supervisors to do more, especially, for example, addressing the data security issue you discussed in the paper?
I mean, so let's take the example of, for example, worries about concerns about your data being leaked. So I think even if preferences would determine that, and we would abstract that even given the same risk, for some reason women think it's much more harmful, I don't think there's such a thing as, too little risk of my data being abused, maybe. So I think we can probably, as a supervisor regulator, adopt a stringent standard on data privacy laws that certainly wouldn't harm men, but still, even if preferences are the difference, could encourage women to use more fintech products and services. So that would be my take. I don't know if Sharon or John have more to add, but it would be one example, I think, where clearly regulation and supervision could help.
Okay, thank you.
Well, I do think that when you talk about preferences, that's quite cultural, social as well. And so I do think, regulators, people in positions of authority do have or can play a role in normalizing certain behaviors, which I admit is long-term and a lot more indirect, but there are definitely things that can be done to not just, I suppose, set the standards, but to encourage, to make certain practices, or whether at the consumer side or at the business side, just common, and make people more familiar. And once you've got that, you've passed that familiarity barrier, you pass the understanding barrier, then you will naturally see more uptake of whatever product you're talking about.
John, anything to add?
Nothing to add.
Okay, thank you very much. I saw a question, but it disappeared. I believe it's answered already. It was actually related to my earlier question. So
David, if I may make one quick comment, also in response to what Carol wrote about
Sure.
the gas station. So
Yes, I was
think it's
about
been
to
like
read
the-
it. Yes, thank
I
you.
think three of
Please.
those questions center on what Sharon briefly touched upon, that, you know, that there might be, I don't think we're missing that thing because there's research on that, but there's solid evidence that, you know, there's fewer female founders in fintech than male founders. So to the extent that you think that maybe, you know, female founders know better what female customers would want, and that's an argument often made, then certainly you could wonder whether there's any market failure preventing female founders from getting enough funding to start their fintechs. I think we're aware of the problem with all the good research, but I don't know if we have found a definite answer of why there are so few female founded fintechs. Maybe Sharon knows more about that, but I think that thing you brought up kind of like gets at the heart of this, right? I mean, if there's demand for products, we need to know about that. Somebody needs to create a product. Maybe, you know, there could be a disconnect here.
Well, I won't touch upon why there isn't enough female founders, because I think that's another 5-10 papers even if we manage to get that research done. But I will say that it's worth remembering that this paper was very much designed to be a global survey. And so in the questions we put together, in the way we've, you know, the methodology that we designed, the idea was to be able to have a benchmark that you can then compare actually very different countries, and then be able to say, well, this we use the same approach for each country, and therefore you might have to there are limitations of countries that you may or may not be able to factor, as you've picked up on, or some of the questions have picked up on, but the whole idea was to have a global benchmark. Whereas I think some of these questions about where there are gaps, where why might, you know, women in one country be more willing to share data or not, all of that, I think there are interesting questions, there are interesting case studies if you dive into specific countries about what's happening. So, you know, what might be seen as a need for women in India is not necessarily a need for women in the US or in Switzerland, and therefore it wouldn't necessarily be covered in our survey. But then if you go and look at what products are available in the market, you'll see that variability in products from country to country.
Thank you. So Calvin mentioned the question again, so perhaps the response wasn't clear. The focus of my earlier questions were around whether men or women are better at understanding the risks around fintech products in advanced economies. Maybe men need more financial education. What do you think?
Could well be.
Okay.
I can give the anecdotal industry view, because I won't be able to necessarily point to specific academic studies. But if you speak to, for example, the people who run investment apps or who run investment businesses, the trend that they tend to pick up on is, I think women feel like they need to have more knowledge than men before they are comfortable with making certain decisions. And then I think, and this is obviously very anecdotal and kind of very broad brush, but men also tend to be much more comfortable with taking risks compared to women. So there is an element of, I guess, at the decision, and also the way the decision or the information is portrayed to them. And both things are things that, you know, fintechs have done to remedy. So there's some very good products in the market that have been trying to bring in behavioral analytics and gamifying experiences to help people understand their risk level, rather than just saying I'm comfortable losing X amount. And then there's also other apps that really focus on helping people understand the literacy, and they're not necessarily targeted towards men or women in particular, but the people who run the apps have very much commented they have noticed differences in how female versus male customers engage with those apps.
I mean, if I may add one academic reference here, John, there's this fantastically titled paper, now outdated titled, Boys Will Be Boys, and Gender Overconfidence in Common Stock Investment. And what they show is that men are very overconfident, they trade way too much, and actually make net returns that are negative at times. So if you think, okay, fintech, maybe men use lots of cryptocurrency, that obviously would be lots of fintech use, but not necessarily socially optimal. So, I mean, that's not what we're saying in the paper, but obviously, it could be the case that, I mean, if you're very risk seeking, then that needn't be the optimal outcome from a societal perspective. that everybody's using products we don't know yet.
Yeah, absolutely. And just to add to that, there is literature as well showing differences in risk aversion. Women tend to be more risk averse, and so it could. And getting to the point that Sebastian mentioned earlier, I mean, there are legitimate concerns around data breaches, around there in some cases there's a lack of regulation of new products and services. So there may well be a case for educating people about some of the risks that they face and making sure that they are aware of the risks of dealing with companies online, of using digital products, and that they are able to protect themselves against those risks. There's probably also a case for regulation, particularly of data use. Regulations like GDPR in the European Union, I think, are being replicated in other jurisdictions around the world. So there is very much, I think, a need for actions here. And I think that one thing that we've also seen in other work is that people tend to worry about issues when they've had an experience with them themselves. When people have experienced a data breach, they're more likely to worry about data breaches. When people have, potentially been subject to discrimination, they may be more worried about discrimination going forward. So it's better to educate people about these things perhaps in advance than allowing these incidents to happen and having them worry afterward. But yeah, again, this is, I think, a role for public policy.
Actually, if I may add a stat from the index, where we asked, at one point we asked the respondents who do they rely on to help with financial decisions. Over a third of women say that they rely on family and friends and colleagues, so they consult essentially, whereas I think about 20% of men say that they don't rely on anyone. They just, and that anyone includes not just friends and family and professional advisors, but also even online and offline tools or government institutions or relationships that they may have with their own individual research. So I think that's quite revealing in their mentality.
Yeah, thank you. If I remember correctly, one of the main drivers of this fintech gender gap in your paper was men are more price sensitive. When they see a cheaper product, they just move right away. So that's one thing, one of my takeaways from the paper. Okay, Calvin, thanks you for your thoughtful answers. And we have a question from George Brady. Behind social cultural norms that may contribute to the gender gap, did you discover any legislative or regulatory barriers to gender equality, whether financial laws, regulations, or other?
So this is a great question, and I think that one thing that we should say at the outset is, as Sebastian mentioned, the country level characteristics actually don't play that large of a role in explaining the gender gap. So that was something that kind of surprised us. But there are, of course, very large differences. Some countries have enshrined gender differences in legislation. There's a great paper by Marie Hyland, Simeon Jankov, and Penelope Goldberg on gendered laws and women in the workforce. They make available, this is in AER Insights, they make available indicators on gendered laws and basically on gender discrimination, in legal frameworks. And it's clear, there are a number of countries around the world that still have differential treatment of men and women in a number of laws, from voting to labor markets to all sorts of civil protections. So that is very important. That could, of course, have a role. And first pillar pension rules, which you mentioned here, I mean, this could, of course, also have a role in the use of fintech. But what we found is that, at least in our survey and for the data we have access to, that this didn't seem to be a key driver of the gender gap that we found. And it's notable that even in relatively egalitarian countries, we still see a gender gap in the use of fintech.
I would also venture that it's hard to, I suppose, say here is the type of policy that does or does not play a role because each country is different. I mean, if you to an earlier question about where there might be gaps in market, if for example, in the UK, most of the fintech products will be very dependent on having some form of identity and some sort of financial history to start with. And I say most, there are obviously exceptions, but the majority of that, if you look at the payments providers, or if you look at some of the investment companies, you need at least some form of, if not ID or bank account, or even a Facebook profile to help with your credit scoring. So that's your ability to tap into those products in the UK or in the US will depend on you having some element of establishing yourself. Whereas in other countries, like some of the more developing ones, where there isn't necessarily that specific requirement, there's a feeling that if you have a mobile phone, then that's all you need. You don't need to worry about having a bank account. And instead the fintech will come in and be your bank account. So it's hard to say that this one legislation will specifically help women, because what we've seen is that fintech will come in and try and fill that gap and work around the legislation, or work around what's already happening at the ground level, rather than treating each country specifically the same.
Okay, thank you very much. I think we answered almost more than 20 questions. This is a record. Thank you so much, including my questions. I think we answered 21, and seems like everybody is happy with the responses. No follow-up questions. I would like to thank you, Sebastian, John, and Sharon very much, and participants and asking questions, making it more enjoyable for us this morning or afternoon or evening in your case. Thank you for joining us today. We will stay on the line with the community of practice members to continue our meeting, which will be closed to public. And thank you again, and stay tuned for our next webinars.